$200,000. Trapped. This is a true story about cash flow blindness. A founder I know had a profitable quarter. On paper, revenue was up. Margins looked healthy. The board was happy. But here's the reality check. Her days sales outstanding was sitting at 63 days. Her payment terms were net 30. That's a 33-day gap. She was pulling from her line of credit just to cover payroll. $200,000 in working capital, trapped in unpaid invoices. No visibility, no benchmarks, no early warning system. What gets measured gets managed. The difference between a CFO who controls the business and one who gets controlled by it comes down to 5 numbers. Cash runway, DSO, gross margin, EBITDA margin, revenue growth. 5 KPIs every CFO tracks monthly. And why? This is the faceless CFO. Corporate finance, demystified. Here's what we're covering today. Number 1, cash runway. Number 2, days sales outstanding or DSO. Number 3, gross margin. Number 4, EBITDA margin. And number 5, revenue growth rate. For each one, I'll give you the exact formula, real industry benchmarks from sources like NYU Stern and Hackett Group, and a worked example. If you stay until the end, I'll also share a free CFO dashboard template. Let's get into it. KPI number 1. Cash runway. How long before you hit zero? This is your survival clock. The formula is straightforward. Runway in months equals your cash balance divided by your monthly net burn. Now, quick distinction. Gross burn is everything going out the door. Payroll, rent, software, marketing. Net burn subtracts your revenue. It's the actual cash you're losing each month. Most investors and boards care about net burn because it accounts for incoming cash too. Let me walk you through an example. Say you have $1.5 million in cash. Monthly expenses, $150,000. Monthly revenue, $50,000. That gives you a net burn of $100,000 per month. Cash divided by burn. That's 15 months of runway. Now here are the benchmarks. Early stage companies, seed through Series A, should aim for 12 to 18 months. Growth stage, Series B through C, 18 to 24 months. Late stage, Series D and beyond, 24 months or more. And here's the pro tip. Below 12 months is a red flag for investors. But above 24 months could mean you're sitting on too much capital and not deploying it efficiently. Here's something most people miss. Runway isn't destiny. A 12-month runway with a declining burn rate is actually better than 18 months with accelerating burn. The smart move? Track 3 things together as a trio. Runway, burn rate, and burn rate trend. KPI number 2. Days sales outstanding. How long does it take to collect your cash? This is your cash conversion cycle's biggest lever. Here's the formula. DSO equals accounts receivable divided by revenue, times the number of days in the period. What it means, the average number of days between sending an invoice and receiving payment. Why it matters. The longer your DSO, the more working capital is trapped. DSO is the single biggest lever in your cash conversion cycle. Let's work through a real example. Annual revenue, $1.2 million. Accounts receivable, $180,000. Days in the year, 365. DSO equals 54.75 days. Now think about that. If your payment terms are net 30, a DSO of 55 days means your customers are paying about 25 days late, on average. Here are the industry benchmarks. SaaS and subscription businesses, 15 to 25 days. B2B services, 35 to 50 days. Manufacturing, 45 to 60 days. And the red flag to watch for. If your DSO is increasing month over month, you have a collection problem. or your customer quality is deteriorating. Here's a powerful insight. Every 10-day improvement in DSO can free up millions in working capital. And the quick wins are simple. Automate your invoicing, offer a 2% discount for early payment, and implement dunning for overdue accounts. Small changes, massive cash flow impact. KPI number 3, gross margin. What percentage of your revenue is actually yours? This is where pricing power lives. The formula: gross margin equals revenue minus COGS divided by revenue times 100. COGS is your cost of goods sold, the direct cost to deliver your product or service. Gross profit is what's left. Revenue minus COGS before operating expenses. Gross margin reveals two things: your pricing power and your production efficiency. Let's walk through an example. Revenue: $500,000. Cost of goods sold: $150,000. That leaves a gross profit of $350,000. Gross margin: 70%. That means for every dollar you earn, 70 cents stays after direct costs. Now let's compare that to industry benchmarks. SaaS companies typically run at 75 to 85%. Professional services, 60 to 75%. E-commerce, 35 to 50%. And here's the warning: if your gross margin is declining, that's pricing pressure or rising input costs. This is a board-level concern. Here's a critical insight. Gross margin is your first line of defense against recession. Companies with 70% or higher gross margin can weather downturns. Below 50%, you're one cost shock away from crisis. KPI number 4, EBITDA margin. How profitable are you really? This is where the full picture comes together. Here's the formula. EBITDA margin equals EBIT divided by revenue times 100. Now, what is EBITDA? Earnings before interest, taxes, depreciation, and amortization. Why does it matter? Because it gives you apples-to-apples profitability. It strips out financing decisions and accounting choices. This is the number private equity firms use to value your company. Let me walk through a real example. Revenue: $1 million. Gross profit: $700,000. Operating expenses: $500,000. That gives you EBITDA of $200,000. EBITDA margin: 20%. That means 20 cents of every dollar stays as operating earnings before non-cash charges. Here are the industry benchmarks. SaaS companies in growth stage, 10 to 20%. Mature SaaS, 25 to 40%. Professional services, 15 to 30%. And here's the key insight. Below 10%, you're spending too much on overhead. Above 40%, you're either extremely efficient or you're underinvesting in growth. Now, here's where it gets really powerful. In the M&A world, the middle market private equity average in 2025 was 7.2 to 7.5 times EBITDA. That means every dollar of EBITDA you add is worth $7 or more in enterprise value. Improving EBITDA margin isn't just operational, it's a wealth creation exercise. KPI number 5, revenue growth rate. Are you building or stalling? This is the momentum indicator. The formula: growth rate equals current revenue minus prior revenue divided by prior revenue times 100. Now here's the critical distinction. Growth without margin is just expensive momentum. The real goal is balance. Growth plus profitability equals sustainability. Or, as I like to say, growth is vanity. Profit is sanity. EBITDA margin is reality. Here's what investors expect. Below 20% growth? Growth stage investors start to look elsewhere. 20 to 30%. Considered healthy and fundable. Above 30%? You get premium attention, but they'll also scrutinize your burn rate more carefully. And this brings us to what I believe is the most elegant framework in finance: the Rule of 40. Revenue growth rate plus EBITDA margin should equal or exceed 40%. Let's test it. Company A, 50% growth plus 5% EBITDA margin. That's 55%. They pass. Company B, 10% growth plus 35% margin. 45%. They pass too. Company C, 15% growth plus 10% margin. That's only 25%. Under the threshold. Neither growing fast enough nor profitable enough. That's the danger zone. And here's why this matters in the real world. The Rule of 40 is the #1 benchmark that buyers use in SaaS and tech M&A. Companies that exceed it consistently trade at significantly higher multiples. It's the fastest way to answer one question: are we balancing growth and profitability correctly? Now, here's where it all comes together: the CFO dashboard. All 5 KP is on one screen. Here's a real example dashboard. Apex Digital Solutions, May 2026. Cash runway, 16 months. Signal, amber. DSO, 48 days. Signal, amber. Gross margin, 38.5%. Signal, amber. EBITDA margin, 17.2%. Signal, green. Revenue growth, 24.5%. Signal, green. Rule of 40 score, 41.7%. That's a pass. Green means healthy. Amber means investigate. Red means act now. When you walk into a board meeting with this, you control the narrative. I've built this exact dashboard as a free template. The link is in the description below. It's an Excel file with all 5 KPIs, formulas pre-built, traffic light formatting already set up. Just plug in your numbers. What gets measured gets managed. What gets managed gets improved. 5 KPIs: cash runway, DSO, gross margin, EBITDA margin, revenue growth. Track them monthly. Compare them to your benchmarks. And watch your clarity and confidence transform. If you got value from this, hit subscribe and drop a comment below. Which of these 5 KPIs is the hardest for you to track? I read every comment. Next video: how I prepare board reports in 2 hours, including the template I use every single quarter. See you there. The Faceless CFO, Corporate Finance Demystified. New videos every Tuesday and Friday.